Dalal Street ends Friday at a one-month low and ends lower for the second day in a row. Could the Nifty below 20-day moving average spell trouble for the bulls? And at current valuations, what kind of returns can we expect from the Nifty in 2023? And is the PSE index on the verge of a multi-decadal breakout? We discuss all that and much more in this week's edition of Editors Roundtable. I'm Reema Tendulkar. With me is Prashant, Anuj, Nimesh and Nigel. Hi guys.
We're actually a full team today.
Yeah, I missed out the last, couple of episodes, but good to be back. And the market's not looking good, of course.
No Santa Claus rally.
Yeah, and especially the last couple of days, I think were brutal. Friday was brutal. I think Thursday the market preempted a lot of Friday decline. But Friday, the market attempted two rallies. Both were sold into. I think the message is loud and clear. And even in the US, I think the market got a bit cocky about what Jeremy Powell was about to say and how the market reacted to that. And next day, I think it had a bit of a reality check.
Okay, so before we get chatting about the markets, quickly, the prediction for the FIFA World Cup
I thought we were keeping it for the end, but...
Argentina.
I have said France 5-1.
5-1.
France 5-1.
I have said France 5-1. You know, when you make a prediction, make it as outlandish as it can be.
And bold. Argentina.
What about you? Argentina.
Argentina.
I think France. I mean, I would want...
So we are 2-2 now. Nigel,
yeah.
you're the...
No, based on form, it has to be France, so I'm going with France.
No.
But
Okay.
heart is with Argentina, so I'm going with France.
Okay, so 3-2 basically. Let's see.
But in
how
the
it
heart for most people would be with Argentina.
Argentina.
I mean, great South American football, so we'll see. Anuj, but the market is not looking all that great, right?
No,
And
it's
this
not.
20-day moving average we've been talking about.
It's not. And actually, you know what? It's decisively broken the 20-day moving average. Yesterday, it looked like maybe you want to still give it one more day.
Yeah.
But I think today, the way it just effortlessly broke that and the two rallies were sold into. Anecdotally, what happens is the break of 20-day moving average leads to a sharp fall. And I think I have the numbers to back it. But before that, the Bank Nifty just about managed to close right at the 20-day moving average. In fact, the Bank Nifty's close was prevailing 20-day moving average. So I think that is still, you want to still give benefit of doubt to the Bank Nifty because it's the leadership index. But let's look at the last few instances of the 20-day moving average breakdowns. And most of this, I'm looking at this year only. Starting with January, on January 21, the Nifty broke the 20-day moving average. And after that, it had a 7.8% decline over a 2-month period. After that, we reclaimed that. And then in April, we had, on April 18th, another 20-day moving average breach. And guess what? This time also, the market fell 7.8%, the Nifty that is. Though this time, the fall was a bit shorter in duration. Come June 13th, the Nifty again broke the 20-day moving average. And this time, the fall was 6.8%. Again, this time, the fall actually lasted for slightly longer duration. And this is what would give hope to the bulls that the next breach of 20-day moving average was a temporary one on August 29, when it breached it and fell only about 3% and bounced back immediately after that. So December 15th, we broke the 20-day moving average. We don't know where it's going from here, right? But if you look at the broader market, there are some signs that, most of the market indices are actually at or below the 20-day moving average. The mid-cap index is right at the 20-day moving average. Metals index is at 20-day moving average. FMCG index is very close to breaking it, just 0.5% above that. Indices which have already broken that, pharma, auto index, no prices for guessing, IT index, 3.5% below the 20-day moving average. The two indices which have managed to do well, capital goods, which till yesterday actually was almost at a lifetime high, is still 2% above its 20-day moving average. And again, no surprises for guessing, the strongest index, the PSU bank index, which is 5% above its 20-day moving average. So these are few indices. In terms of stocks, again, no surprises, HCL Tech, Infosys, the ones which are the weakest, below the 20-day moving average. Kotak as well, down about 4%. Stocks with strength, you have ONGC, IndusInd Bank, and Larsen & Toubro. Larsen, remember, even yesterday's trade made a lifetime high. Now, the stocks that I'm watching out for, which are at a make or break zone, right at the 20-day moving average. The close today was at the 20-day moving average. What are these stocks? You have SBI, you have HDFC Bank. Both of these stocks are right at the 20-day moving average. You have Reliance, ITC, and ICICI Bank. The three stocks which have led the market rally, they're now 2% below the 20-day moving average. If these stocks correct a bit more, then I think you are in for a sharper correction. That's what the anecdotal data tells us. Let's see if this time it's different or not. But what are you tracking, Reema?
Well, I'm today talking about the correlation between the Nifty valuations and what in the past have been the kind of returns that we've seen when the valuations are at current levels. So currently, the Nifty is trading at valuations of 19.5 to 20 times. So over the last 2 decades, when the Nifty has been hovering around these valuations, what have been the expected one-year returns that we've seen. And we often hear from investors that Indian valuations are expensive, much higher than what emerging markets are trading at, and that makes them a little cautious in India. But what exactly are excessive valuations according to India's standards, historical standards? At what point does the risk-reward turn extremely unfavorable, right? That's what my piece is about. So let me start with the current valuation picture, right? Currently, as I said, we are at 19.5, 20 times, higher than the long period average, but we are not at the highest peak valuations. The peak valuations in the Indian markets from an Indian market context has been close to about 25 to 25.5 times. So here I'm breaking up, the valuation versus the return argument into two buckets. One, valuations at expensive levels, frothy levels, and that I'm constituting at between 22 times to 25 times. Now, in the last 2 decades, there have been 4 instances when the Nifty has traded closer to that 23, 24, 25 times kind of valuations. And you would see in 3 of them, in 3 of these instances out of 4, the Nifty has given you a negative return. The worst has been, around the Lehman crisis when the Nifty fell close to about 50% in the next 1 year. These are the annual returns that we've seen when the Nifty is traded at these. Your best case has been only a 1% average forward return on an annual basis. So the point is, from an Indian market historical context, frothy valuations perhaps are closer to 23, 24 times, 25 times, and that's when the risk-reward has turned hugely unfavorable. Let's talk about India's current valuations, closer to 20 times. What has happened when we've hit these valuations in the past 2 decades? Well, as you can see, there are multiple instances when the valuations for a long period of time have been around that 20 to 22 times forward multiple. More often than not, you've got positive returns. But the extent of positive returns has been fairly moderate. Your best case has been low teens kind of returns, and on an average, you would have got, a mid-single digit kind of return. So the bottom line is that perhaps as we set to enter 2023, we are trading at valuations which are higher than a long period average, not excessive by historical standards, but maybe 2023 may not turn out to be a year where you get super normal, returns. It could be a year where you get moderate returns, and that's what history tells us. Which then brings us to the next point that we're going to be talking about on Editor's Roundtable. If 2023 indeed has moderate returns, is it time to look outside of the equity markets, perhaps at debt? And Prashant, you've got some interesting analysis there.
We told our viewers about the problem, which is high valuations, 20-day moving average, etc. Let's tell them the solution also. And the solution perhaps is fixed income. This is according to S. Narain, CIO of ICICI Pru. Listen in, it's a 30-second bite, and then we'll come back and present some data.
If you look at the last month, what we saw was that debt index fund have received huge inflows, and that's something which possibly as a product didn't exist 2 years back. So I think clearly we are seeing a situation that people will consider debt and SIP, both, and that will be the change which we will see in 2023. I think the big call will be that inflation will become much smaller as an issue in 2023. And therefore, we are in a situation where multi-assets become very interesting, that you consider all the asset classes.
They say, hope for the best, but prepare for the worst, right? And the way to prepare for perhaps things not going as well as they have in 21 is fixed income. That's a solution you heard from S. Narain, CIO of ICICI Pru. Now, our audience is very attuned to, investing in equities because we've lived through this TINA kind of environment, right? There is no alternative except equities. But I think now you're getting to a point where fixed income instruments are getting to be attractive. They're vying for attention and they're competing for flows as well. Let me just quickly tell you, how interest rates have moved across a variety of fixed income instruments, starting from call rate to repo to 3-month, 6-month, 1-year commercial paper. You're basically now getting anything between 6% to 8%, 6 to 8%. And if I compare where these rates were on the 31st of March 2022, they're up anything on an average between 250 to 300 basis points. And this is just, F5 till date. So we've seen a pretty large jump. The graphics are on your screen. So where do you invest, right? You want to invest in debt, fixed income instruments. There are, we all know the Public Provident Fund. We know post office savings. We know tax-free bonds, fixed maturity plans. But there are debt mutual funds as well, which Naren was essentially saying is perhaps the best way to go. And I'll get to why he thinks it's the best way to go. But before that, within debt mutual funds, I mean, I'm not going to go into all of them, but just focus on debt mutual funds, just the kind of debt mutual funds there are and the options which are available to you. So, you know, the first is the overnight fund or the liquid fund. I mean, this is a product which largely, you know, you can say it's like the savings bank account. You have excess money, you park it there, you take it out when you need it. I mean, the investment duration usually is between 1 and 7 days. It invests in overnight securities. By the way, Naren made a point that liquid funds are now giving you 6.25 to 6.5% returns, and this is largely practically risk-free. So that's one. You want to sort of increase the time horizon a little bit. There are money market funds, and money market funds by definition, I mean, RBI rules don't permit them to invest in assets with maturities more than 12 months. They invest in things like commercial paper, certificates of deposits, treasury bills, etc. And here, I mean, I looked at what funds are yielding. The average is about 6.75%. Slightly longer duration funds, I mean, these are what you describe as up to 1 year kind of schemes. They fall in the bucket of low duration funds. They invest in all kinds of things. I mean, bank CDs, CPs, T-bills, G-Secs, state government loans, etc., etc. Returns here are largely aligned to the 1 year certificate of deposit, which is between 7.5 to 7.6% or so. So, you know, now you're getting to 7.5 and more kind of levels. And then you have the 1 to 3 year kind of category, which also yields about 7.5% in terms of returns. As I said, you can go longer, but over 3 years. There are, you know, there is a 3 to 5 year bucket, over 5 year bucket. But the point is, at this point, you know, you don't know how the rate trajectory will really pan out. So there is always the option to invest in, say, for example, a 1 year fund or a 3 year fund and then sort of reinvest it. I mean, for longer if you think that it's yielding similar or better returns. Taxation, just a quick point on how taxation for debt mutual funds work. Taxation only on capital gains, and after, if you hold it for 3 years, you charge 20%, but with indexation benefits. There is higher liquidity as compared to investing directly in bonds. These are highly, I mean, many of them are very, very liquid instruments. And of course, there is also the investment horizon, which is extremely flexible because, I mean, there's liquidity available when you want it on call. You can sell these units and redeem them as you want. So some amount of capital protection as we head into 2023. I mean, I think that's something to keep on your radar, explore a little bit more, talk to your investment advisor, and perhaps take some exposure as well. Back to Dalal Street, back to equities, where deals still remain very, very hot, Nigel.
Well, that's right. We're drawing to the close of the year, but Deal Street is up and buzzing. You can't take your eye off that. And this week itself, we had 3 big deals that were announced. So first up from the cement space, that's Dalmia Bharat. Well, they went ahead and they announced a deal. The other one is the pharma deal. That's between JB Chemicals as well as Glenmark Pharma. And the third part is TPG going ahead and picking up a subsidiary, the housing finance subsidiary of Poonawalla Finance. So let's start off with the Dalmia Bharat deal first. They went ahead, they got close to around 10 million tons from JP Associates and JP Power put it together. Now, the JP Associates assets, well, it's integrated. So it's a good deal for them. 5,600 crores they're paying. They're getting close to around 10 million tons. So that would mean an EV per ton of around $75 per ton, which is very attractive. And keep in mind, they get an entry into central India with more than 10% share. So they become a pan-India player, and they're close to doubling their capacity now in the next few years. From 37 million tons, they've been talking about 75 million tons. That puts them on course. The problem is there's an arbitration with the Ultratech Cement for one of the clinker units, that's 2.5 million tons. Part of those assets are in a JV with SAIL. SAIL has 24%, so will SAIL bargain hard. And the third part is, what about the additional capex they have to spend? What about the limestone and the land? So that's about Dalmia Bharat. The sheet was a little bit, first took it positively, then some bit of a pullback because of the negatives. Next up, the clearest deal. That's JB Chemicals as well as Glenmark Pharma. They picked up the Russell portfolio for around 315 crores. Remember, it's been in sales of around 60 crores. So that deal is stuck at around 5 times sales, which is pretty good. It gives them the entry into the growing statin market and also makes it more popular among cardiologists. So that's why that were the positives that were viewed out there. The management spoke to us on CNBC-TV18. They said that their acquired portfolio gives margins of around 55%, which is good news. And in the next few years, from 60 crores, they look to take it to around 100 crores. Most of this will be funded via debt. And finally, Poonawalla FinCorp, well, they have sold their housing finance arm to TPG. That will be done for around 3,900 crores or thereabouts, which means the price to book value of closer to 3.5 times. Initially, the street said, well, it's a good deal. The problem is what's left. You're selling the secured part of your book, and the unsecured part of your book is there. You have a lap book as well as some pre-owned vehicle finance. So a little bit skittish on the developed pending book. So that's why the street was a little bit skittish. But otherwise, we had Adar Poonawalla who joined in. And he said that they're looking at improving ROE, ROA from year on. They're looking at growing the book by around 35 to around 40% or thereabouts. And they're saying they don't require any more capital. So big deals announced this week. Next week,
we heard most of them on the
on D Street. Absolutely, we heard
plug my thing as well.
We are plugging that in. We are plugging that in.
Of course, congrats to you, Nimesh, on that. By the way, the point Prashant made about 7%, 7.5%, and I know a lot of people would scoff at that. Actually, this year, Nifty has done 3.65%. We get a lot, swayed by the recency bias of the last 2 or 3 months. Technically, this year, the market has not given you anything unless you were in the right stocks. And if you bought a Nifty basket, even this year, you would not be beating the fixed income by a lot. So this 7%, 8% risk-free is not something to scoff at. In fact, Neelkanth Mishra was making this point that, we've already had a lot of PE expansion. That's the only reason we've had a rally, not because of earnings expansion. So I think I take your point. I mean, I myself am looking at, putting some money in fixed income.
And Naren was saying that it's already happening for the last 2 months. Non-SIP flows, a lot of it, because we are seeing this discretionary amount shrink to next to nothing. A lot of that is going into debt. And last month, apparently, was very large.
And just personally as well, there are some instruments which a normal working class person as well should put. One is that VPF, the 2.5 lakhs that you get out there. The PPF, as well as if you have a daughter, then the Sukanya Samriddhi 1.5. So 5.5 to 6 lakhs, you're clearly getting an average of 7.5% or easy peasy. Next 8 years, that money doubles.
And Nigel said normal people, right? Not Nigel, right?
Me, I'm doing it.
If you have 2 daughters,
You're lucky.
Okay, we'll take a break now. Up next, of course, we'll be joined by Rahul Arora, CEO of Nirmal Bang Institutional Equities, to give his view on the last state and, of course, a lot of individual stocks.